Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
All right. Well, good morning, everyone. July the 9th. A little bit of AI leasing strategy here from Backyard Ventures, and then just a quick update from Charts of the Week. We're talking about AI and stuff like that offline. And so Backyard Ventures is one of our newest partners, and they put out a really good update, and they've said that they would update us periodically on kind of how the AI trade is infiltrating real estate. And I kind of suspected this might be the case, but I really didn't know that 94% of multi-res operators are now implementing or planning to implement AI this year, and 86% of them are now um, running multiple pilots at once. And among the operators who've deployed the AI, and we have a couple in the fund that are already doing this, 77% reported lower OpEx, which I guess makes sense. Um, and the more kind of surprising number is that 85% have reported higher um, leasing conversions. So I guess, for that part of it, they don't really need people. And, it's something that you're kind of seeing from a retrofit perspective too. Like some of the tech that we bought, we own two technology companies in the real estate fund that I found. And it's not all new development. That they're actually both have pretty big, retro businesses. And that's pretty interesting. So check out these stats here. So this is kind of an overview of capital raised um, just in June, right? So just the last month, 650 million, of which nearly three quarters went to housing related tech. And so you can see down below the capital primarily went to um, the housing side of the equation, but also a lot into construction and then some commercial real estate and operational stuff. But these are pretty big numbers, and I think you're probably going to be hearing more about real estate prop tech um, more this year. It might be one of those areas where um, there's like a lot of the other areas of AI might be contracting. This one, fingers crossed, seems like it's growing. And housing is certainly very much still where the money, quote, lives, as they say. So you could see, Nesto raising 216 million, Square 95, and so on and so forth. And these residential deals took $7 out of $10 out of a $50 trillion U.S. residential asset base. So there's a lot of opportunity here. It's a big, huge runway, and we might only just be getting started. So, I spoke with Grata yesterday. A couple of days ago, I talked with the team at Boom, and things are going almost pinch me well. I don't want to jinx myself because we do own a fair number of shares of both companies, and so anytime you hold direct private company, especially tech companies, you're kind of just sort of a little bit anxious, I guess. And construction tech had one of the strongest, months of the year, with groups like Hiarc and Dara. Um, there's really a strong sense of confidence in these technologies, like using essentially, and this is something, I've been doing since I started here, was just, okay, there's AI in tech and it's always been there. Um, but how can you use it for like things like engineering, automation, and productivity? Not some stupid website or something like that. And it's also been very concentrated. So you can see down below, they say that five deals took over 3/4 of June's disclosed capital that was raised. So I think that this is going to be the sort of you know behind the scenes story of 26. Like there's going to be a lot of other AI stories for sure. But this housing one's looking pretty good. So just in terms of, the charts, the technicals, um, from SOT strategy, Andrew's talking about a sharp and violent rotation out of semis. We certainly saw that, and I think a lot of us felt that, depending on what segment of the market we were talking about. That looks like there was a little bit of spillover, but Wednesday's session did show signs of the weakness kind of spilling over into other areas. So let's take a look here. It seems as though the S&P 500 got to a point when the summer started and is now just sort of oscillating back and forth. The kind of neutral level and the overbought level, the first so-called standard deviation there. So it's looking like it's waiting for something to happen. The big sort of near term, I guess, as Andrew calls it, tactical point, is right down there. And there's a bigger one that I think gets its cues from the 200-day moving average. The 200-day seems to be the better thing to follow for not only the S&P, but a lot of individual names in general. I don't know how much you can get from the 50-day. It seems in the short term, no one really knows what the market is doing. And I know that sounds cliche, but just look at some of these semiconductor and other memory based and AI based indices or ETFs. DRAM is the new one. So there was MAGs, which was the MAG 7, and then they came out with another one. The Round Hill company came out with this DRAM one, which is digital random access memory if you have a comp sci degree. But Micron really came off here, and you could see SanDisk and some of the other ones as well. And that's really not the best news for some of these tech weighted ETFs, certainly such as the Nasdaq, but perhaps more from a concentrated perspective, the XLK, which you can see down in that lower panel. In fact, there's actually a decent risk in the near term that the semiconductors kind of, I guess, ricochet off or bounce off again. The 200-day, this is sort of a confluence of multiple technical indicators. You've got that green sort of area of support, the 200-day, and then this uh, uh, channel that's kind of narrowing in. And if we break down through here and this zone kind of fails, then it looks pretty problematic. So I think what you're looking for here is really a very um, stiff, definitive bounce off of these levels. I want to show you these spaghetti charts. I always like these because what a spaghetti chart is it kind of shows where the dot started, and you could see like some of these names and indices really transitioning from improving or leading back down into um lagging or weakening. And the socks, like there's some long lines there. Like you could look at the socks and some of these other um positions. It looks like you took like a big pen, red and yellow pen, and just drew a long line down into lagging. So just shows you how much and how quickly things can change. The other thing too that I personally really got to spend a lot of time on, because I don't follow it nearly. I follow debt capital markets for commercial real estate, but the bond market itself, I really don't. And the messaging from this chart is that it remains, as Andrew calls it, right? These are Andrew's words, not mine, a sideways mess. But you can really look at this chart, and I don't know how you can make heads or tails from it. Like our 10-year yields going up, down, sideways. it's really unclear. Uh, but I guess in these situations where stuff is so opaque, you really, put on your contrarian hat, and maybe that's the way to play it. So we'll see. Now, the good news for stocks, and we get this question all the time. I think we got it 3 times yesterday in client meetings, is that, you know, is it still okay to get in stocks, and how does that all look? And, from a credit perspective, it it looks okay. There's not really anything in these, high yield, option adjusted spreads that would suggest that spreads are just, massively ballooning out. It's not anything sort of, to be alarmed by. And then finishing off, this is that, KWE, Chinese Internet, CSI index, as he likes to put it on here, and he really, uses this chart selectively. I think here he's just, pointing out that as it went down through that red line, it did catch that lower, dotted line of the range, and it did so on sort of a conversion or a rotation in its own momentum. So potentially, um, an area for tech. But like I say, um, there's just so much. It's one of those markets where there is this temptation to just turn your computer off and come back in September or October. uh, it's really tough to call. So that's, I think that's all I'll say, and I'll pass it back to the team. Have a great summer, guys.
Okay, great. Ken, you want to take over?
Yeah, for sure.
Awesome.
I will just go over the normal 2 disclaimers. Canadian investors, US investors, just basically boils down to we're not giving securities advice. Contact us today. Talk to one of our portfolio managers. Looking here, S&P 500 5 box increase. Everything I'm saying is over the last 2 weeks, just because of the holiday-filled week last week. Obviously began its reversal yesterday. Overbought, oversold 12%. It's increased over the last 2 weeks, but the lowest 3-week period since the Iran sell-off. Semiconductors and AI are obviously leading the losses this week. Numerous names were off over 20%. You can see there, most of them to do with the AI trades. So, bit of I'd say more of a rocky week, depending on where you're invested, especially with the peace deal seemingly blowing up, and the ceasefire ending. NASDAQ here, no box change over the 2 weeks, but it had 6 column changes. It created a buy signal last week, followed by a sell signal yesterday. It's kind of been in this range, you can see, going back to 7 or 8 weeks ago. And then it has one more line of support in the short term. Then you'd have to go all the way back to the lows that we got to at the beginning of the Iran war. Despite the pullback, obviously still up about 15% year to date, maybe 14%. Overbought, oversold about 5%. This is the first week it's been oversold since April 3rd. And all 3 of the last weeks have been below 3%. So really low levels for the overbought, oversold, and low demand, it seems, for we'll call them risk on assets right now and growth stocks. Dow Jones 2 bucks increase over 2 weeks, plus 10 year to date. The growth value spread has really shrunk in the past few sessions, after widening out just a few weeks ago. Support 6 and 9 bucks is lower. A strong week for most of the components of the Dow, other than Caterpillar and Home Depot. We're currently on the longest positive momentum streak on a weekly basis since 2006. So something of note there. Overbought, oversold highest since May 29th. So despite some weakness in the S&P and the NASDAQ 100, technical picture looks a lot better for the Dow. TSX 60 here, no box change over the 2 weeks period, despite obviously some commodity volatility. It still remains up double digits in 26. Obviously a strong week for the beneficiaries of the conflict, continuing, I guess. Energy, fertilizers, etc. Have to see how long energy prices kind of remain in the low 70s with current state of the market. Overbought, oversold 38% remains elevated despite some commodity weakness relative to U.S. Markets. And then a lot of the TSX defensive names continue to display some strength, which is really helping the TSX out right now with some precious metal volatility. Looking here at the VIX, 1.5% decrease over the last 2 weeks, 2 new sell signals followed by a buy signal yesterday. It's yet to really reverse this downtrend that it has begun for the last few months. You can see it's been kind of flat in recent months. I was looking for periods where this kind of happened over the last few years. Couldn't look back at their data set yesterday for some reason, but we'll continue to look at that. S&P 500 bullish percentage chart moved up 8%. Dow Jones up 6%. Dow Jones, New York Stock. Sorry, I was just reading the wrong slide. S&P 500 up 8%. NYSE flat. These charts tend to be a little backward looking, so it's kind of taking with what they give you. These percentage positive trend charts are backward looking more or less. They're kind of lagging indicators in my opinion, but nonetheless, you can see the strength probably from a few weeks ago, and then we'll see a bit of a reversal unless the recent trend in the market right now reverses. TSX, no changes here, so we'll just flip through quickly. And then asset class rankings over the last 2 weeks. Only beneficiary really been commodities. Everything else from a high level losing buy signals. In domestic equities, tech actually has pulled back pretty substantially over the last 2 weeks. So tech obviously at one point, I think sitting at 230 buy signals, now at 204. So that spread minimizing. Energy obviously with quite the whipsaw in recent weeks, same with basic materials. But continuing to look at some of those more defensive sectors for our client exposure right now. Utilities, some consumer staples, some healthcare, some financials that are trading kind of cheap. Just for some more defensive posturing right now with where the market's at. Looking here, this is the major sector performance and the Dolly rankings. You can see kind of the whipsaw of some of these. Obviously, energy, the biggest move downward, and then the biggest move upward really being tech or healthcare. But you can see the returns on a quarterly basis, year to date, and then the 1 year. Everything's actually, every sector, I don't know the last time this has happened, on a 1 year basis is up over the last year. Obviously, communication services very minimally. But like I said, consumer staples on a Dolly ranking, when you're ranking the asset classes, not ranking very strongly, but you can see the quarterly, year to date, and 1 year returns being positive. Obviously, based on relative strength and the number of companies in there, there's a lot of consumer staples that are that have been, I guess, left at the curb, like the likes of Kellogg's. I read a thing on the cereal industry earlier this week in one of the newsletters, but nonetheless, some strength in a lot of the other names in that consumer staple space. Looking here, I had some research done for me on South Korea. Fund remains at almost a 5 out of 6, which is a buy for us on the technical side. The price target is slightly pushing downward. It's up 87% year to date. Obviously, there's a lot of concentration risk in this ETF. This is the iShares South Korea ETF. You can see created 2 sell signals, and it's at really a breaking point right now. It's a little more support in the short term. So we're watching that because we've owned it for a few years, and there's obviously some tax implications for some of our taxable clients. But really, the technical picture still looks pretty strong. It's began to deteriorate a little. It's been oversold the last 2 weeks after being heavily overbought for most of the period since April 10th. But the upside really weighs on the AI trade. It's trading a lot cheaper than it was in past quarters. The technical picture, as I said, is mixed. If you really have to do your research on the likes of Samsung and a few other companies just because of the heavy concentration risk. I think the top 10 companies are like 50 something, 53%, forget. But nonetheless, very interesting, obviously, market, kind of been leading the global equity markets for the last 18 to 24 months, obviously, because of the AI trade, but we continue to follow it very closely. Little different market here, UK. Had some research also done for me on this. So I looked into it. Very interesting story, compelling, obviously. Moderate economic data, really got to watch it. In England right now, slower growth, we'll say. But from a technical picture, this chart looks quite compelling just because of it's been trading in this wedge for 7 or 8 months right now, and it looks like it could break up or down. So if it breaks to the upside, it could be a potential very attractive entry point. The fund's only up about 7% year to date. It scores at about 4.8 out of the 6, which is a buy. There's been recent negative momentum, some alternating between overbought, oversold, so moderate demand. And the PE ratio is only about 17.5 times earnings. So pretty attractive from a fundamental standpoint, I'd say, compared to other developed markets. And then the actual exposure within this iShares ETF, it's not heavily tied to AI and tech. Only about 1% of the ETF is exposed to AI. So if you're looking for exposure X tech market that's not as heavily influenced directly by tech, obviously indirectly it will be, but very interesting there. Crude oil here up 22% year to date. The ceasefire ends. Oil's back up to 74. This chart hasn't turned over. We'll have to see if it does turn over in the short term. I was mentioning a few weeks ago that we only had one last line of support at 57, obviously reversed much before that. So we'll have to see how oil trades in the coming week. This is just a chart that tracks the strategic petroleum reserves. Right now, the U.S. SPR is at 319 million. That's a 43-year low. The U.S. has a $150 million operating minimum, and many believe that they will try not to draw on their reserves when it gets past 250 million. So basically what I'm saying here is that there could be higher prices, obviously, if a resolution does not come to fruition. Right now, it seems like prices are being kept lower by China and the U.S. This is actions. How long can those actions continue? We'll have to see and continue to watch product draws that we've seen over the last 10 to 16 weeks. This is just market expectations for the Fed funds rate, obviously talking about higher energy prices, inflation worries. You can see today the blue line. This is from Charlie Blow, but you can see over the next 6-7 months, we can see where the expectations for the Fed funds rate will be. Obviously, an expectation of a hike sometime at the end of the year. At the start of the year, the market had expected a couple or 2 cuts essentially by the end of this year. So quite the change with this new conflict in the Middle East. This is an interesting chart long term. I was talking to Ethan, who is one of the summer students with us. He's helping me out with launching our new debt fund and working on the deck really for investors when it's ready. And I found this slide when I was doing some research and reading just up on the long-term cyclicality of debt markets, just to present in our deck. And I found this data set really interesting. Obviously, we all know the secular cycle of the highs and the lows of the bond market, where the long bond yield is obviously on the top, but you can see on the bottom momentum. And we've just hit, we hit this low in terms of in terms of interest rates recently. So we're going to have to see where this momentum draws us. This is obviously momentum related to the long bond yield. You can see it going back to the 1840s as they're measuring it on yearly data, currently pointing up higher, which would obviously reflect higher interest rates. Some people have been saying that for quite a long time, or we'll have to see if that does come to fruition and how high they can even get to with the current state of global debt levels. But nonetheless, very interesting chart. Speaking of interest rates, Japan's borrowing rate again hits another 30-year high this week. This is their 10-year bond yield. Continue to see, will Japan break the market? Yield surging, borrowings rising everywhere, governments, individuals, companies within Japan just continued borrowing. Obviously, the yen trade collapsed a couple of years ago with the rise of interest rates. I'd say past year and a half, it's really kind of collapsed. They've had obviously collapsing birth rates, sort of employment, labor participation issues. The yen's at a 40-year low. Inflation's above 2%. Obviously, after 30 years of deflation and really relatively low growth right now, obviously in Japan. So continue to see numerous risk factors there. What's that led to? Hedge funds are continue to ramp up their short yen positions. You can see here their highest short position since before the financial crisis in late 2007. So very interesting times there. Only two more slides. This is just gold. This is imports by Hong Kong as they gear up for a launch of an exchange within Hong Kong. The largest buying we've seen since April of 2025. Over the last 2 months, I told people in the newsletter that we write a couple weeks ago, central banks continuing to buy gold, even with the prices pulling back, seeing it as an opportunity rather than a time to panic and sell. We think this allocation to gold is going to be a decades-long rotation away from other assets like U.S. Treasuries or euro-denominated assets and into gold, which is seen as more of a safe haven. And then just last slide, I was playing around with AI this week, obviously with Strategy's recent performance, kind of took a page out of Sean's book and created one of these memes. So just looking at Michael Saylor here, couldn't get his face to look exactly like him, but hopefully you don't own this one or any large positions in Bitcoin, obviously, with the recent performance there. And that's it for me. So I'll pass it back to
You gotta say, Ken, I like that addition.
Sean and the rest of the team. Thank you.
That's a good one. So, Sean, are you ready?
Yeah.
Awesome.
Okay, here's my macro thoughts for July 9th. Wasn't on the call last week, but been watching the markets relentlessly. Okay, the big change for me is I'm reducing my long positions pretty much across the board. I'm feeling this market is getting toppy. SpaceX is kind of indicative to me of the insanity in the market. Looking at hedging, using index puts and outright, just being short futures. Do I have any short positions? None yet. I'm considering SpaceX and some companies related to the AI trade. My forte, the crypto market, still fragile. I keep telling people just avoid it. Recently had a guy who at one point had over $50 million of Bitcoin, and he's out of it completely right now. It's just a broken trade at the moment without the Clarity Act. There's just not a lot going on. If the Clarity Act comes through, I see Coinbase and Galaxy Digital being the big beneficiaries. Over the past week, the asset classes, despite my moaning here, Bitcoin and Ether did well over the week. But, long term, they're still not in play. What's notable is, the US dollar was basically flat over the week. The S&P barely moved. Bonds were down a bit. Gold was up a bit. Outside of crypto, everything was like dead calm. I don't think that that's going to continue with Trump calling off this truce. Economics, basically the same. Things are just slow and steady. The Fed priced for a couple of hikes. I think the Warsh is going to find an excuse to do something like keep things either neutral or even sneak in a cut by saying the economy needs it because of high oil prices, which are going to be temporary and resolved after the war. That would be a market shock that would benefit Trump, benefit the asset holders, and will be a true shock to the market, which I think Warsh is looking to establish himself as like, I'm not going to tell you what we're going to do. You're going to see what we're going to do, right? Unemployment, basically the same. CPI, just really high relative to the target. I just, there's no company, no CEO that could get away with being so far away from, their revenue targets, for example, and why the Fed can continue to do it, I just don't know. Growth, as projected by the Atlanta Fed, took a major dump. We were looking at 3% over the last few months, and it's now fallen to 1.3%. I think the oil shock is filtering into the U.S. economy. Gold sales may have been slowing down a bit, but this is a major shift downward in the growth outlook. The recession, still not now. Commodities turbulent. The dollar's been a little bit stronger. Housing is tepid, and the U.S. consumer, it's a little softer, but the spending is still there despite low confidence. Here we see the U.S. dollar, a 1-year chart. It's this is a little bit longer than a year. It's trending up recently, and that's a flight to quality in a war situation, totally to be expected. The long-term trend for the U.S. dollar is lower, lower, lower. That's going to benefit gold and eventually Bitcoin. The yen, as was pointed out by Ken, definitely weaker. 2 weeks ago when I brought this up, I said there's likely going to be a BOJ intervention. We had a small one. The yen fell 1.25% in a single day on July 2nd. To put that into context, these are massive assets. So a move of 1% in a currency in a day is really quite astounding. But we've seen that in other BOJ interventions. I don't know when they're going to step in and, we're going to have 1 or 2 days of big candle down days of 2 to 4%, where the BOJ is going to be okay, now we got higher oil prices again. We need a stronger yen. How much are we going to spend to intervene? What are we going to do? We're going to sell U.S. treasuries, get those dollars, and then basically buy yen against it. So watch this space. Gold continues to be in a bear market. Interest rates are attractive to a lot of people at these levels. We're off more than 25%, I guess, right now from the high. But once we see this shift in the Fed stance to an easing bias, a higher liquidity bias, I think we will see gold move above 5,000 again. I'm prepared to buy it in 3,300, 3,400. Silver, same dynamics. I thought that the solar demand out of China would absorb a lot more silver. It hasn't. I'm wrong on that trade, so far. And I expect support, a fair bit lower. So I've been working my way out of that trade. Oil, oil's popped higher. Trump has hit Iran 2 days in a row. Iran is basically thumbing their nose at Trump, just saying bring it on. You say worse is to come. Let's have it. Let's see it. This is not a good situation. Every day that those U.S. warships sit off the coast of Iran, the better the targeting will be when these guys decide to swarm a ship with a drone swarm. If they impair or, God forbid, sink a U.S. ship, I think we'll see easily $150 a barrel oil. And Iran is basically, they know where the strategic reserves are for both China and for the U.S. And they're just playing that. They will play delay as we approach that, minimum threshold in the strategic reserves. You're going to see Trump basically have to capitulate, right? He cannot drag the world into basically a recession / near depression because Israel dragged him into a war. Like this is going to be problematic. There's no way the United States can take over Iran like they did with Iraq or Afghanistan. Totally different geography and a much different population, like a huge population. They're not going to subdue 90 million people. They've got to basically find the people in Iran who can take control. Rates and credit, pretty boring over the last few months, frankly. Everything is basically unchanged. I'm just watching these high yield spreads. They actually got a touch tighter, but like they're way below the long-term average. We're still in the broad retail market, dominated by fear. It's quite surprising. The S&P, by my count, you'll see only has one short-term indicator being risk off. We have good breadth, good market participation. The VIX structure is normal, and spot VIX is at 16.9. I swear, if it gets down to like 12 or 13, that will be my trade. I will be long the VIX. The AI spending is in focus, and we're going to get to that a little later. So the triple Q, the equity regime, the model is doing quite well in its accuracy. The 1 day forward probability of being in a bull market, 95%, 5 days forward, 80%, 20 days forward. We're starting to see that come off a bit, 65%. The expected remaining duration in the bull by the model's estimate is about 19 days. And just to put it into context, here's like the last 20-ish years of the model characterizing the triple Qs: green, bull periods, yellow, sideways, and bear. And so we've been experimenting with some research that we'll get into that argues being like 100% or more invested when we're in a bull market, being 50% invested in a sideways market, and being zero exposure to triple Qs in the bear periods. The S&P is sure looking like a top to me. A few trend indicators have flipped red, as you can see by the heat maps. The first two at the top are, our proprietary set of the blue, yellow, and green. Blue being the shortest term indicators, green being like 60 days plus. And then we have some other trend indicators down below. Two have flipped red. I think this is primarily on the AI concerns. And I just want to note that SpaceX is not in the S&P 500, but now is included in the NASDAQ 100. Crypto, just bad. I just don't see anything good happening at the moment. If you want to play in the space, buy a December call option on Bitcoin, Coinbase, and Galaxy Digital, but size it appropriately. Bitcoin is just in a bear market. I've been saying for over 6 months, who needs Bitcoin? By all accounts, we had a little pop on expectations of something being announced on July 4th, but that just turned out to be a big fat rumor. And we've had a sell-off since then. The Senate has got to get this Clarity Act done. I mean, I just can't say it enough. And if that happens, plus Coinbase coming into the banking system, I think we have a chance for a 20 to 30% rally in the short term. but I do expect we're not going to see support until later this fall. So research, we've been doing some stuff on regime-informed positioning. We see parallels right now to the market being similar to the tech run and then crash of 2000. So we've been examining how stop losses and other risk mitigation techniques will protect capital. So basically, like stops at 8% below entry costs seem to do the best as just like a hard rule. We're going to be building a lot more nuance to this, but we're building out distributions so we can do simulations. So we're not just looking at a historical path. And our goal is to have a dynamic positioning based upon rigorous regime identification and asset momentum characteristics. Some of the stuff we've done, like when we looked at okay, where are these crazy returns coming from? The bear market is a high volatility space where you have returns that are 3 standard deviations away from the mean that you would expect across the entire period. So we're building out, deep analytics to deal with these 3 different regimes, which we've been able to consistently and rigorously determine. Across looking back over the period of the tech crash, we said, okay, well, what would have actually worked in our different strategies? And just a trailing stop of 8%, delivered over that same period where buy and hold was minus 7.6%. The trailing stop kept returns at 14.9%, and that's without using any shorts. And when we look at, our triple Q regime switching risk management model, we built out 7 different strategies and then had them compete. And the regime scaling model, where you scale exposure by what regime you're in, did the best, right? It had a average mean of 6.7% over these 60-day windows. Why so serious? Why are we doing all of this downside research? Because of this. The AI trade, if we look at 3-year price returns, hyperscalers up 203%, infrastructure-related companies such as Oracle, Power, or Quanta and similar companies up 3 times, semiconductors up 5 times. Okay, these are amazing moves. You go back and you look at how much has NVIDIA fallen, what have been their worst drawdowns in the past, and they've fallen by 80% a couple of times. Even this morning, I found a hallucination in a Perplexity run. Perplexity is an AI that I pay over $2,000 a year for, and it's not supposed to hallucinate. But this morning I caught it doing exactly that in their super premium AI offering called Computer, right? So I wrote to it. You can see my thing. The sentence appears wrong, and it says, "You're right. The body says 67%, and then it dug into it and it says, the most likely explanation is hallucination." Unbelievable, right? So I had to spend probably half an hour making sure that hallucination can't happen again. So the AI trade has driven the index overall for the past 3 years. CapEx is just extreme. We're starting to see companies cap use of AI. We're starting to see countries tell their companies, hey, you might not want to be dependent on Anthropic or OpenAI, or potentially Google, if the US government, at a stroke of a pen, can cut off access to a model that's driving your software or research development. Now, open source Chinese models such as Qwen, GLM, Kimi, DeepSeek, you can get those at the China price, about 10% of what the US models cost, and they deliver about 90% of the capabilities. I've used some of these. They're certainly not up there with Anthropic Claude Fable 5, but they're quite good for the vast majority of work that you have to do. And I just bought a computer just to run Hermes Agent. It's a free tool that coordinates agents, and you can have them running 24/7. You can have them running locally on your own computer. And they now have come out with what's called a mixture of agents framework. So you can have multiple AIs be assigned a prompt, and then like a super aggregator, such as Claude, Fable 5, assess the results from these far less expensive models. And you are going to get, frontier plus level results. It's pretty exciting. So right now, I see parallels to the .com era and the 3D printing trade. So the next theme that I think is going to happen is like physical AI in robotics. And here's the cartoon: Elon Musk meeting the CEOs of a few of the big companies, BlackRock, Goldman. Meet the newest SpaceX shareholders. He's got basically a couple million Optimus Prime robots out there. That's it for me.
Okay, thanks, Sean. It's great. Not as catchy or funny as Ken's, but that's still pretty good, I think. So, okay. Okay, so I hope you guys can see my screen. Just a quick short report today for Thursday, July 9th, 2026. S&P 500 still trading well above that 200-week exponential moving average. And again, this is the level from which we don't see a lot of material upside from here. I didn't update this chart for this week because the market's essentially been sideways this week. And what we see here is that this consolidation period after a nice rally, and this has happened numerous times before since the lows in 2022 here. And typically what happens is we need a sort of a pullback before the market can gather its forces and move higher. Now, that's not always the case, but I think that given what we've seen with this massive rally off of the April lows, the March lows, we're going to need some stronger catalyst in order to push the market higher. Now, this is one thing I want to point out. Typically, when we see credit spreads this narrow, what that means is that there's not a lot of more upside from the market. So, not necessarily saying that the market's going to collapse here, obviously. However, typically when we get spreads down to this level, as we've seen historically, we don't get a bigger move higher in the market. So, all is calm and all is steady, but the question is for how long. Cape ratio continues to be up here at .com levels, and I think as Sean pointed out here, this is kind of a scary, precarious position to be in. Again, just pointing out the potential for upside here might be limited again, just because of where we are on a cyclically adjusted basis here. Defense versus growth. Again, another metric that shows that we are up here where we are. Excuse me, another metric that shows that we're up here where we were in the .com highs, just getting close to it. Personally, I wouldn't be surprised if we were to have a nice little pop-up higher here with one last hurrah to growth. Maybe if we get IPOs for AI, but at that point, we're essentially as high as we've ever been when it comes to defense versus growth. And when we take a closer look here, yeah, again, so we can see that we're kind of consolidating here a little bit. If we're this is just a closer look at that previous chart here. So this is just taking a look at the top right from a closer perspective. You can see we've been consolidating since about May, when that rally sort of petered out, and it wouldn't be a surprise if we get a move higher here. But then again, when we take a look long term, yeah, we're pretty extended on a relative basis here for defense versus growth. Market breadth, I'm only going to take a look at stocks trading above the 200-day exponential moving average. And again, we're not at these extreme levels, right? At the red band up here where we're above 75%. And what that says is that we're not getting the participation that we need, even though the market is moving higher. And again, that has to do with the fact that we're weighted so much, these AI tech stocks, and they're pulling the market higher with a lack of breadth. So it's going to be really all about growth and what happens for growth in the next 6 months. So if you are concerned about that, we have a solution with our partners at Universa. Reach out to us and we'll be able to help you with that. So that's it for me this week. Anything else? Any final comments? I don't have a cartoon, although, given the fact that Ken's started doing that, I might try and make a cartoon when it comes to some of this stuff, but who knows? Any final comments, guys?
No, nothing for me.
Okay. All right. Well, thanks everybody for watching, and we will see you next week. Take care, guys.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.